There's been a lot of things affecting the market this year, much more so than usual. As you can see in this slide here, money market reform is, came to fruition this month. We've got this Brexit, which appears to be going to go forward now, and the clock will begin to start in March of 2017 toward the UK leaving the EU. We've got kind of oil in the oil market with a potential OPEC agreement. Of course, we have the ongoing uncertainty about the Federal Reserve and what's going to happen there. We've got the presidential election, and then we've got the other half of the developed world now with negative interest rates and the fact that they're trying to stimulate their economies through extraordinary means like QE programs. So all this is kind of a backdrop on what's really going on here in our market. And this is the kind of the structure of the presentation I'm going to go through, talk a little bit about the economic outlook, the Fed, the yield curve, the elections coming up, and then just some kind of big picture macro thoughts on relative value within the fixed income market. Well, any discussion, I guess, of growth really has to start with the Fed and kind of their kind of miserable predictions as to how the economy is going to grow. And as you can see in the circle here, each successive what we call SEP meeting, or meeting where the Fed actually gets together and makes economic projections, those are quarterly. The growth for 2016 has been going down. So you can see we started at 2.4. At the next meeting, they reduced it to 2.2. The following meeting, it went to 1.95, 1.8, and we're probably going to go down from there when we get to December. But in terms of the inflation rate and the unemployment rate, they've kind of been in the ballpark there, but the street is forecasting this year that 2016 the economy will finish at about a 1.5% growth rate. So nothing kind of to write home about, and it has been a kind of a slow growth economy coming out of the Great Recession. So the next slide here, we kind of talk about how volatile you can see quarterly growth rates have been. We actually had a negative growth rate in the first quarter of 2014, and as you can see, kind of the first quarter of each successive year has been kind of very weak. Right now, the last quarter GDP was the second quarter. That was 1.4. The street is expecting a much stronger growth in this quarter, the third quarter. Consensus is at 2.7%. Although the Atlanta Fed has their own growth model forecast, they call it GDP Now, and that has become increasingly popular because of its relative accuracy. Their growth rate is 2% for the third quarter, and that's actually coming out on Friday. So the market has been waiting a long time to really see if the economy is going to grow as expected this quarter. All right, let's spend a minute talking about the Fed. Here's in the top box here, we talk about what are the real objectives of the Fed. Well, maximizing employment, achieving stable prices, and getting moderate long-term interest rates. So, generally have done an okay job here, but as I mentioned before, their forecasts have been pretty poor. And Jeffrey Gundlach, who's kind of become the new Bill Gross of the bond market, who's the CEO at DoubleLine, had this great quote. I think that's pretty appropriate. He said the Fed's forecasts for growth are a triumph of hope over experience, like a second marriage. And I think if you kind of follow the Fed on a week-to-week, quarter-to-quarter basis, you can see how that seems very appropriate. Well, right now, I think the market has pretty much priced in that there's a high probability that the Fed will increase rates in December. And as of the 20th, it was at 69%. I believe as of yesterday, it had gone up slightly, up to 74%. So there's a very high likelihood, according to the Fed Fund Futures contract, that the Fed may move in December. Now, the next meeting, of course, is in November, but that's only less than a week before the elections, and is really only being priced in a 17% chance of that. Virtually no one expects that's going to happen. But this is the base case, kind of, that the Fed's probably going to do something in December. I want to play the devil's advocate for a minute and talk about some of the reasons that may not happen. Well, the first thing is, when the Fed talks about the economy's getting strong, they always say, well, the unemployment rate's been going down. Well, that's true. As you can see from this graph here, we are down at 5% now. So we have gone, we started closer to 10% back in 2010. And but the other thing is here in the green line, you can see that the what's called the labor participation rate has been going down. So basically what that means is a smaller percentage of the overall population is actually working, and that's gone down from close to 66% a few years ago at the onset of the recession, all the way down to the current level, which is 62.9%. So there's a lot of people that have left the workforce, and we call them the missing workers, and there's a great deal number of them. The other thing that kind of gives some caution to whether the Fed will actually go is there's this index called the Labor Market Conditions Index, which is actually a favorite index of Chair Yellen. And really what we see here is we've been below zero, which is kind of a neutral line, or we're basically having negative labor market trends for 8 of the last 9 months. So it's kind of hard to fully believe the rhetoric that the Fed's putting out there when you look at some of their favorite indices and they're kind of flashing caution signs. Here we've got the core inflation rate, the PCE. The Fed sets the target at 2%. We're right now close to 1.7, so it has gotten better. You can see back earlier in 2015, we've been down around 1.3%. So, the general trend has been higher, but we're still nowhere near 2%. As you can see, we haven't been at 2% since April of 2012. So we've still got some wood to chop there in terms of achieving the inflation goal of the Fed. And then the other thing is here, as I mentioned, third quarter GDP may be slowing. This is kind of at the beginning of the quarter, you can see that we were almost at 3.7 or 3.8% in terms of the Atlanta Fed's forecast, and we're right now around 2%. So clearly there's been some economic numbers that have come out in the quarter that lead us to kind of downgrade the growth path, and a lot of that's related to consumer spending problems or issues, as well as just inventory overhang that is kind of particularly on the retail part of the economy, that has kind of led to less consumption and less spending on the part of retailers. And then the other thing, is kind of a busy slide here, but we talk about the dollar. And the dollar now has actually gone up, and it's closer to 98 to 99 right now. And the last time we've been up at these levels really goes back to the first quarter of this year. And when that happened, we really saw the economy start to sputter. Strong dollar, of course, means that exports get hurt or reduced, less competitive. And it also means import prices appear cheaper to us here in the States. So that tends to be deflationary. So these are just some of the things that could offset. My base case still is they're probably going to do something. They're going to raise rates in December, but there are some headwinds that I wanted to point out. So let's talk about the yield curve. Comparing where we are now in terms of rates and the shape of the yield curve, you can see that the green line, which is at the beginning of the year, we actually had higher rates and we actually had a steeper curve. And as you can see, the 10-year is down over 50 basis points since the beginning of the year, whereas the 2-year is down 25 basis points. So there has definitely been a flattening trend when you look at it on a year-to-date basis. However, if you kind of look at it post-Brexit, so, instead of comparing versus the beginning of the year, we go back to the beginning of July or shortly thereafter the Brexit vote. You can see the opposites occurred. We've actually got a steeper curve now, and we actually have higher rates. So instead of touching the all-time low on the 10-year back in July when we were back around 1.38%, now we're about 177, I think, this morning. So, although the trend still is, when you compare against the beginning of the year, a flatter curve and a lower rates, the opposites occurred since we bottomed out in July. Okay, and this slide we're just talking about the forecast for rates. So this represents the blue chip economic forecast. So all the Wall Street economists kind of submit their predictions and kind of accumulated and put into the form here. As you can see, from where we are now, we're still expecting higher rates going over the next year, and we're expecting a modestly flatter yield curve as measured by the 2s versus 10-year part of the yield curve. So that's kind of the base case. All right, I'm going to spend just a few minutes talking about the elections because the elections really are important to the financial markets. The first slide here is just the financial futures contract by the Iowa electronics markets. And the blue line here is the Democratic line, which of course represents Clinton. The red line is the Republican line representing Trump. And, really the only thing I want to show here is that, of course, the blue line is ahead. There was a big spike here, and that represented the Trump audio tape. That's since normalized, but still, since pre-audio tape, the lead has widened. The other thing I'll mention, too, is that when we look at the presidential race, there's, a lot on the news. They talk about the national polls where Clinton may be ahead 7 or 10 points or something like that nationally. That really doesn't mean anything when it comes to selecting the president because it really all comes down to the Electoral College. The Electoral College is a winner-take-all kind of contest. So, for instance, if Hillary Clinton gets the majority of the votes in California, she gets all 55 Electoral College votes from California. And the way the Electoral College votes are determined is based on a number of House representatives in a particular state. So this is representative of the Electoral College map as determined by the Associated Press. Now, this is as of the 16th. Now, I think they still had it relatively close. They had Clinton at 272 versus Trump at 190. I think that this has widened in the last few days. But the trend, as you can see, you need 270 votes to win. Blue states are Clinton. Light blue means leaning Clinton. Red states are Trump. Pinkish color means it's leaning Trump. And the tannish or grayish color states are toss-up states. And those are the big toss-up states are Florida and Ohio. And being here in Ohio, and I can tell you that the airwaves have been saturated with anti-Trump ads for the last month, Clinton seems to be outspending him by a wide margin in terms of those ads. So that's kind of where we are now. The big states that are for Clinton are clearly in Clinton columns are California, New York, and Illinois, and some of the other states that are in Trump's category that are large are Texas with 39 electoral college votes. That's probably his biggest prize on the map. But more importantly than just the presidential vote is what's going to happen with the Congress. If you look at the situation in the Senate, there are 34 seats up for grabs in the Senate. It's really kind of slanted against the Republicans retaining control because the Republicans have to protect 24 Senate seats, whereas the Democrats only have to protect 10. So right now it's kind of a too close to call situation. Most are saying that there's a good chance the Democrats will regain control of the Senate. They only need 50 votes to get control of the Senate, assuming Clinton wins the presidency, because the way the Senate is set up, the vice president is called the president of the Senate, and he gets to vote whenever there's a tie, so he can break the tie. And we've seen that actually happen in practice. I know at the beginning of Bill Clinton's term, the vice president at that time, Al Gore, broke the 50-50 tie and basically imposed a tax increase in early 1993. So there are occasions where that comes into play. So right now, as I said, there are 5 kind of toss-up elections, but this is the Senate map as determined by the University of Virginia as of the 20th. They're saying it's right now it's 40-40, 7-47 with 6 toss-ups. So I think that a lot will be determined, I guess, as we get closer. But statistically, as I said, the Republicans have a lot more seats to protect, and it may be difficult for them to retain control of the Senate because they need 51 seats to retain control. Now, the situation is a little different in the House of Representatives. They have 435 seats. All of them are up for re-election every 2 years. Right now, the Republicans have a 59-seat majority, and most are forecasting the Democrats will make some inroads there, but the Republicans are favored to retain control of the House. So what does that all mean? And this is that same betting Iowa Electronics Markets view of this, and the green line, as you can see, what that represents is the Republicans winning the House, the Democrats winning the Senate, is the highest probability according to these futures contracts, and right now that was at 44% probability of that happening. The next largest is the red line here, which is GOP House and Senate. That would be the Republicans' fantasy scenario, and that's only a 19% probability. It's kind of hard to see, but the blue line here, or this purplish line, is Democrat control of the House and the Senate. That's less than 19%, I think somewhere in the 18% probability. So what that all means is the base case is that Clinton will win and we'll have a divided government. That is somewhat akin to what we have now, of course, with Obama president, a Democratic president, and a Republican control of the Congress, both houses of the Congress. Base case scenario is probably that Republicans will win the House but not the Senate, and they'll have a less power. But the lower probability would be a Clinton one-party control. If Clinton wins the presidency and the Democrats control both branches of the Congress, then what you have is a one-party control, which is probably a little scary for the bond market, because what that means is there'll probably be a lot more spending. Republicans will have a difficult time acting as the way they do now, which is a counterbalance to the president, to the Democratic president. So what does that all mean? It means probably in either case we're going to get some steepening of the yield curve, but in the scenario where there's one-party control, we could see a pretty significant steepening of particularly the 10s-30 part of the yield curve. And the reason for that is that it's just bigger deficits, more inflationary pressure, and more Treasury issuance. All those kind of factors will probably drive interest rates higher and the yield curve steeper. So the next couple of minutes, I just want to talk about big picture relative value, talk about a 30,000-foot view of the markets. The first thing I think that's important to remember is the interest rate risk now is very high. I've been in the market since the mid-1980s, and I can tell you back then, interest rate risk, we had much higher coupons on Treasury bonds, and as a consequence to that, and interest rates were higher, and because of those two factors, durations were lower, and you could absorb interest rate shocks upward. So what this shows us, if you just concentrate over the last 11 years or so, you can see that the 10-year in 2005 was at 5.14%, and what that meant is that to get a 0% return on owning the 10-year Treasury, interest rates could go up 77 basis points. Or if interest rates shocked up 100, you'd have a negative 1.5% return. Now, if you fast forward to where we are now with the 10-year at 177, you can see we have a much longer duration on the 10-year Treasury, and we can only absorb 22 basis points of interest rate increases before you reach a 0% return. And if rates were to go up 100 basis points, you'd have a very negative return. So, my first point here is that interest rate risk right now is elevated. So what we're talking to clients about is really not extending duration much beyond the natural target or portfolio duration target at this point. The other thing is, if you look at where spreads are now, both yields and spreads are very low, and as a consequence, you're really not being paid a lot to take credit risk. And we're getting to the point over the last few years where corporate leverage has been rising, which of course again makes it a little scarier to own marginal credits like triple Bs because of the fact that should the economy start to falter, they could be downgrade candidates. And there's always been a historical kind of big gap between where triple Bs and double Bs trade, and unfortunately most of the time you don't want to be on that gap when things go in the wrong direction. So what we're telling clients now is that you're really not being paid a lot to take credit risk. The credit curves are relatively flat, and therefore it probably makes sense to have an up in quality bias in your portfolios. Third point here is interest rate volatility. Right now it's been trending downward over the last few months. We are expecting volatility will probably pick up as we get closer to the elections, and we get closer to the FOMC meeting in December as well. And therefore, if probably not the optimal time to be buying bonds with embedded call options, such as callables or agency MBS, just because we think there'll probably be a better entry point once volatility starts to normalize and pick up again. And then finally, in terms of structuring portfolios, right now we're recommending people look at bond ladders. Bond ladders are a good strategy when because it's a conservative strategy, and it particularly works well when interest rate outlook is somewhat uncertain, and that's probably where we are right now. We're economy's kind of got a lot of uncertainty, and the ladder strategy allows you to kind of navigate any unexpected rate shocks, which is probably good advice right now as opposed to a barbell or a bullet strategy. So with that, I'm going to turn it over to my colleague, and he's going to talk more specifically about the way we look at bank credit and portfolios in general.
Thank you, John.
Andrew?
Good afternoon. Hopefully everyone can hear me okay. I want to talk about how we help our clients with pre-purchase analysis and post-purchase analysis and why that's important. Basically, in 1992, the regulators came out with a statement that provided that institutions should not hold high-risk mortgage derivative products in their investment portfolios. In other words, CMOs. And the way they defined a high-risk mortgage derivative product was a security that failed one of three tests. One of the tests was the average life test, which basically was saying you couldn't own anything greater than 10 years in the base case average life. The second test was an average life sensitivity test, where the weighted average life could not shorten more than 6 years in rates down 100, 200, or 300. And then conversely, it could not extend greater than 4 years in a rising rate scenario of up 100, 200, or 300. And then finally, a price sensitivity test whereby the price could not change by greater than 17% in either rates up or down. That was the 92 statement, which was in effect until 1998, at which point that test was rescinded. At the point where that test was rescinded, the onus now became more on the individual banks to do pre-purchase and post-purchase analysis in the context of managing their investment portfolios. So basically, I wanted to go over why that PFIC test was rescinded and what now in terms of what the regulators expect. The reason it was rescinded, it was because of basically unintended consequences. Basically, when you've got a test that has to be run not only at the time of purchase, but then subsequently, it was kind of viewed as, hey, rather than deal with the burden and the scrutiny that I'm going to get by buying these CMOs, let's just stop buying them altogether. And so, I've heard clients in the past say CMO stands for count me out. That is not what the Fed wanted as a result of rescinding the PFIC test. They just basically wanted banks to really focus more on pre-purchase analysis and to look at and manage the investment portfolio in the context of the rest of the balance sheet, which includes not only looking at the securities portfolio and individual transactions, but also looking at things like AL models and how the management of the securities portfolio affects the overall balance sheet interest rate risk management. So the second unintended consequence of that was that the bank shifted to doing really more risky strategies in structured notes. So they moved away from buying CMOs, and they went into things, structured notes that may have leverage formulas within them and more complex cash flows. So it really needed some clarification from the agencies. So rather than having a pass-fail criteria of the PFIC test, they decided that was no longer an effective way to supervise investment activities. And so really what they want to see, and banks used to do this all the time, was just file away a FIFIC test. Whomever the broker dealer was that sold them a security, they printed off the FIFIC test at the time of the purchase, and then post-purchase, a lot of your bond accounting systems would run post-purchase pass-fail FIFIC testing on the portfolio, and then obviously any ones that showed up were brought before a committee, and it was decided whether or not they would retain or dispose of those assets. So more effectively, I want to touch on kind of the scope from a best practice standpoint to meet regulator expectations. And that is one, to just establish a comprehensive risk management process that identifies, measures, monitors, and controls risk associated with investment activities. You know, that includes things such as policies, procedures, limits, the identification, measurement, and reporting of risk exposures, and then a system of internal controls. A lot of those things are kind of out of our wheelhouse, but one thing where we can help our clients is to actually identify and measure the risk associated with not only individual transactions, in the case of a swap out of some poor underperforming securities into some securities that are a better fit from an interest rate risk management standpoint. So we can help with the identification and measurement of those risks prior to the acquisition as well as after. In building out our analytics platform, you can see on this page an actual swap that we did. This is a client that we've done multiple transactions with. But if you look in the summary highlights, and this is something that that can be filed away, and the regulators, it goes through all the different aspects of the trade, why they did it, and this should be something that should be viewed very positively by the regulators. So in the case of this transaction, it was basically selling 1.78 duration assets, $15 million, taking a $3.8 thousand gain, and reinvesting in assets that are basically 0.5 year in duration, picking up between 40 basis points and 102 basis points in yield between base and rising rate scenarios, shortening duration by 1.25 year to 1.75 year between base and up 100, reducing negative convexity and dramatically improving the total return in the rising rate scenario. So that is the impact of the swap that's in the middle. You also have on the left-hand, upper left-hand, you've got the impact on income in years 1 and 2, as well as cash flows, and then portfolio results. How does this individual swap impact the overall portfolio in the upper right-hand side? And then down at the bottom, you've got in the comment section, balance sheet, income, interest rate risk details. So this trade basically worked to pick up over $100,000 over 2 years while reducing duration and better positioning for rising rates. It picked up nearly $300,000 in 5 years in base case income and nearly $500,000 over 10 years. So this ultimately works to decrease the cash flow, as we've been stuck in this low rate environment for quite some time now. Cash flows are having to be reinvested at lower and lower rates, which is decreasing the overall portfolio yield in many of our clients' investment portfolios. So this not only improves the yield profile, the total return profile, but it also decreases the cash flow and allows the client to capture the upward movement in 12-month LIBOR, which has increased over 100 basis points over the last 12 months. In the trade summary, you've got all the numbers that kind of drive the bond swap analysis summary page. So you have the shock numbers that feed into those numbers on both the left-hand side, which is the swap itself, and the right-hand side, which is the impact of the swap on the entire portfolio. And then on the next page, you can see graphs that show the book yield comparison between the swap in the upper left-hand side and the total return comparison between the buy and the sell. So you can see the green line is showing a significant improvement in both book yield as well as total return. And then the two graphs on the right-hand side of the page is the impact to the portfolio itself from the swap. So you can see pretty marked improvement there with respect to the portfolio. On the next page, you can see, as mentioned on the first page in the summary, you can see the sell side, which is labeled up towards the top on the left-hand side, and the buy side. You can see the impact of this trade in terms of not only income, but also cash flow. And then the graphs represent those numbers below, and you can see the green line shows the impact of income versus the sell side, and the blue line, and then base case cash flows. Lower right-hand side, you can see we really smoothed out the cash flow in the case of this this trade versus what we were selling. So much more stable profile with respect to this portfolio and this trade. On the next slide, we can see, now this goes, everything that I talked about previously goes to pre-purchase analysis. And then we run our portfolio summary comparisons. This is quarter over quarter. The trade that we actually did was our third transaction with this particular client as we continue to fine-tune their investment portfolio to counterbalance interest rate risk in the rest of the balance sheet. But this is a second quarter versus third quarter comparison, which actually breaks out second quarter by security type, and you can see the difference in book yield, average life, effective duration, with the differences along the bottom highlighted in yellow. So you can see where the pickups are there. The trade sought to actually improve the book yield while shortening duration, and you can see that it accomplished exactly that on a go-forward basis when looking back a quarter. The next slide will actually show you more detailed information in the shock rate scenarios. And I think, one of the more important things to look at is the gain loss down at the bottom in the portfolio differences. You can see rates up 300 and 400, nearly a $1 million improvement in the gain loss. So you're really looking to be in position in rising rate scenarios. If you get into a scenario where you need liquidity and you need to capture that via selling securities, if you can do it at a $1 million less loss, that's certainly going to position you better to be able to meet those funding demands. And then you can see the difference in book yield, duration. This trade accomplished exactly what it was supposed to accomplish. Finally, at the very bottom, highlighted in yellow, you can see the improvement in total return, 23 basis points, up 100, out to 121, plus 400. Getting into more specifics on the next page with respect to total return. Total return is just capturing not only your coupon or yield income, but also the movement in price in a rising rate environment. The previous total return numbers for the portfolio are in blue, whereas the post-trade total return, when you compare the effects of the swaps at 9/30, you can see a market improvement in total return there that performs markedly better in the uprate scenarios. And then the details that kind of drive that graph are on the next page. Here you can see the numbers are up at the top. You can actually, it breaks out all the specifics with respect to what total return components are there: income, price return, and annualized return. But you can really see what we accomplished between 6:30 on the lower left-hand side and 9:30. We worked to really move the shape of that shock scenario total return curve to really move the profile of the uprate scenarios from declining to actually flat or actually improving. So again, these are the kind of things that the regulators are going to want to see now that they and it's been a while since they rescinded the FIFIC test, but these are the kind of things that regulators want to see when they come in and start reviewing transactions and how the securities portfolio is being managed. This actually shows them that you're doing your homework prior to as well as analysis afterwards. And that kind of concludes my comments on pre-purchase and post-purchase analysis.
Awesome. No, thank you so much. What I'd love to do is to open up for any questions you guys might have. We do have, you'll notice there's a question box there on your GoToWebinar screen, so feel free to type in any questions. And also what I'm going to do is I'm going to launch a polling question. I want to make sure that anybody that wants to get some more information about Fifth Third and what they do for many banks all over the country, that you have an opportunity. So you'll see the question up there. Are you interested in learning more about Fifth Third? If you'd like for them to take a look at some of your portfolios and see if there's some recommendations they can make, we'll get this information to them. And any questions? I'm going to give a couple more minutes for this polling question. All right, I'm going to go ahead and close the poll. Awesome. Well, I'm not seeing many questions come in. I know that was a lot of information, but I do want to thank you guys for joining us. Great information. If you do want a copy of the slides, we're going to be sending those out as well. And we've also been recording this, so if there is somebody else at your institution that wants to hear it, we can coordinate that. But with all that being said, I want to thank you guys for joining us, and thanks to everybody for listening in today.